we've come to the end of what has been another choppy weeks in the markets, but joining me to discuss next week is LCG head analyst Brenda Kelly. Now, Brenda, let's start by talking about Sunday night. There's Japanese fourth quarter GDP data coming out. Now, the market is actually expecting a contraction, is it not? So what can we expect from dollar yen, for example?
Well, dollar yen is going to be an interesting pair to note. It has broken through some key levels, key the 114 level over the last number of days and weeks even, given the fact that we've seen a lot of choppiness in equity markets, which has driven investors to the safety of the Japanese yen. This has obviously been to the detriment of the Nikkei, which has fallen 5% this week and 4% on the Friday morning as well. So ultimately, the outlook is not that great in terms of the Nikkei strength. So what I've been looking for at the moment is, yes, there'll be a contraction, and we would expect at this particular point that given where the dollar yen resides, that the next level to aim for will be around 110. And there is actually a long-term head and shoulders pattern on the dollar yen chart, which now that we've seen that neckline broken around 113.50 would suggest that the ultimate completion will be around 107.25. So lots of downside there, but you have to be conscious of the fact that we have seen speculation that the Bank of Japan has intervened in the FX market. Just yesterday, we saw a flash spike up through 113. So be conscious of that if you are trading it, because even any speculation that that's taking place could very well reverse the dollar yen direction. And of course, the possibility of additional negative rates from the Bank of Japan, albeit that they were unsuccessful and temporarily unsuccessful the last time, is always there and always a possibility.
Well, moving on later into the week, we've actually got central bank meeting minutes from various central banks, inflation reports. We've got some employment figures coming out of the UK, and obviously, of course, we just mentioned Japan. Taking a look at the macro calendar next week, what else has caught your eye?
Well, China is back from the week-long holiday, and nobody can blame China for the fact that we've seen such volatility over the last week or so. But we have their trade surplus coming out, trade balance coming out, and it's going to be quite an increase in its trade surplus to about $63.5 billion US. I'm expecting to see export growth maybe pick up a little bit, which has happened from a very low base last month. Also, import growth, given the fact that yuan has depreciated considerably, likely to pick up around 4.8%. But there will still be questions about the capital flight from China, and it will be very interesting to see whether or not the Shanghai Composite plays catch up with the rest of the equity markets when they do return to the desk. But that being said, there has been very little sort of action within the yuan over the last week or so, but it could be the calm before the storm, and it could ultimately feed more volatility into an already volatile market.
What about Chinese inflation figures on Thursday? Well,
Chinese inflation figures are also certainly one to watch, I would say. And certainly, we are expecting to see it pick up around 1.9% year on year. And food price inflation probably going to be the most robust part of that. That being said, commodity prices are likely to have stabilized because of the yuan weakness. So I don't think it's going to be a major factor unless it actually doesn't meet expectations. But the market is penciling in a consensus of 1.9%. And I would anticipate that will be how we see the number actually print.
Okay. In terms of meeting minutes, we've got the FOMC meeting minutes on Wednesday night, and we've also got ECB meeting minutes on Thursday. Are we expecting much in terms of perhaps language, trying to understand about what the policymakers are thinking, especially the FOMC?
I think the FOMC is probably something of an outlier this time around, because we have had Janet Yellen over the last number of days testifying before the congressional committees. So we have a lot of data or detail from her, albeit it's kind of a rhetoric, a lot of rhetoric from the same before. Her testimony yesterday was the same. She said US dollar strength was a signal of economic strength, and that weak oil had been mostly negative for the economy but could be good overall. But she also said as well that the Fed has and continues, it doesn't actually misread the effect of the US dollar strength on the global economy. And now we have got the Treasury market pricing in the possibility of a rate cut. So we have seen quite a reversal in the US dollar strength over the last number of weeks. But any sort of indication within those minutes that there are some who are pumping to actually maybe hike interest rates, maybe not in March, but maybe in the summer, that could give a little bit of a boost to back to those highs. Nevertheless, I do feel that there's very little more information to be gleaned from those minutes. I'd be more interested in what the ECB have to say. Mario Draghi, certainly given the data we've seen today, Italian GDP on the quarter only rising 0.1%, expected 0.3%, overall GDP in the Eurozone 0.3% growth. Not great. Inflation still exceptionally low. Inflation expectations still at record low levels as well. So the anticipation of more negative deposit rates from the ECB and possibly something a little bit more imaginative in terms of what it can do to stimulate the economy will be what people will be watching out for. But he might have to hold firm on that until the actual meeting in March, and then we'll get our surprise there. Nevertheless, with that in mind, the euro is still very much the go-to funding currency, and while there's choppiness in markets, we do remain reasonably bullish on the euro, particularly against the pound and even against the dollar as well. Certainly when it comes to the pound, I do sense that we have got a little bit further to go on that, and my levels are as follows. If we get above that 78.90 level, we can more than likely rise towards 79.60, which coincides approximately with the 200-week moving average. And then on the euro dollar, similar such a situation there. If we can manage to keep this momentum going and stay above the 112.60 level, then we have got more room to extend higher, and we could see a potential move up towards the 114 level.
Okay. In terms of any other potential trade ideas or opportunities in the market, given the volatility that's going on at the moment, you were talking to me recently about dollar CAD. Is that still of interest to you?
Well, dollar CAD is very interesting to me because of the fact that it is very much correlated with what's happening in the oil market as well. And we do have some CPI coming out of Canada later on next week. And that is going to be, I think, expected to rise core price 0.1%, but the actual consumer prices are going to fall by 0.2% in the month. So there is still a little bit of room for action from the central bank there. And as it stands, I think while we're above that 135.30-ish level, there is a good chance that we will boost a little bit higher, the dollar versus the CAD that is. And I would imagine that we could actually head towards the 140, 120 in the near term if there is a disappointment in the CPI number there from Canada.
Brilliant. Thank you very much, Brenda. We'll leave it there. That's all for this week's version of The Week Ahead. Good luck trading. Have a lovely weekend, and goodbye for now.